Stephen, a big week then for oil. It has been. Prices have been grinding higher. Just unpack what's been underpinning the moves higher for oil and whether or not you think that's going to be sustained.
Yeah, I mean, I think definitely we're seeing now the impact of the Red Sea and that risk sort of kind of funneling through to oil prices. Since the tension began a few months ago and the Houthi attacks began in the southern part of the Red Sea, there wasn't an enormous impact on oil prices. But now that more and more companies and oil traders and suppliers are avoiding the Red Sea, which is a key passageway for the Suez Canal connecting Europe and Asia, that is starting to cause some disruptions. Folks have to take the longer route around southern Africa to get their fuel there. So there's some displacement of supplies. At the same time, tanker rates, the cost of renting a ship to send the fuel is also going up, and they're at the highest level, basically, for some routes since 2020, when there was such a big glut of oil in the market that people were using tankers to just store the fuel, and there just wasn't enough. So we're getting to a situation where oil tankers are getting tighter, and that's pushing things higher. Of course, we also have the U.S. oil stockpiles are falling more than what the market was expecting. So that's also showing that maybe there's a brighter demand picture in the United States. And you have Chinese stimulus, the government's doing what they can to pick things up. All those combined, creating more of a bullish scenario for oil over the last few days.
Yeah, interesting that Saudi Aramco, according to our colleagues, is, the world's largest oil company, is continuing to send its tanker loads of crude and fuels through the southern Red Sea. So we'll watch how that develops. Stephen, you mentioned the other factors also supporting oil prices, and how do inventories play in here? Because the China stimulus seems quite obvious what's happening here. What does the inventory story tell us in the US?
Well, I mean, the inventory story in the U.S. shows that, I think maybe take a step back, right? One of the big bear scenarios for oil this year is non-OPEC plus supply. Where is non-OPEC plus supply? That is U.S. production from shale plays. So there is this expectation largely in the market that the U.S. was going to be flooding, everyone with shale oil, both domestically and overseas. But as you see inventories in the U.S. drop more than expected, yes, that is a demand picture, right? That's a demand story. The U.S. is using more, but also that's a story of supply. Maybe supply isn't as resilient as the market is expecting. Maybe there are some cracks there because, when you do get to a lower price point, some drillers decide not to produce as much as they would if oil were at $80 WTI or $90. So those things together kind of paint a picture of, okay, how resilient is this U.S. shale output? It is something that is clearly in the top of the mind for the market, because when you look at where supply is coming out, OPEC Plus, they've been reducing their output to help try to balance the market. But shale, they can't do that. It's a bunch of independent producers. So that's one of the more of a bearish sort of element that has really caught hold in the market over the last few months.